So, good afternoon, everyone. I'm excited to be here today to discuss probably one of the most fundamental and impactful aspects of trading, which is volatility. Whether you're a scalper, swing trader, investor, volatility is a key factor. It influences every decision that you make in the market. So, understanding volatility is not just about the numbers on the chart, it's also about understanding the personality of the market and how it behaves under different conditions. So today we'll cover what volatility is, why it matters as a trader, how DTT uses a time series analysis to provide deeper insights into volatility, and then we'll look at the role of the indicator as well and some practical strategies to apply this knowledge effectively in your trading. And then we'll probably end with a Q&A. So who's ready? Now, understanding volatility, what is volatility? At its core, volatility is a statistical measure of price variability. So it tells us how much a market or asset's price fluctuates over a given period of time. There are two primary types of volatility to understand: historical volatility, and if you're trading option pricing, implied volatility, right? In this case, we'll just look at historical volatility here in the markets when it comes to DTT. Now, there's a dual nature of volatility, and I do want to preface this, what do I mean by that. So volatility has a dual nature. It creates opportunities, right? Some days when volatility increases, we can capture really large moves. We can get pretty big returns, right? On those days, I'm sure we're all happy. But consider this analogy because volatility can also pose risks. It's a double-edged sword. On one side, it can cut through stagnation and choppy environments, and it can create large movement, large opportunities. But on the other side, if it's not handled carefully, it can also lead to losses. So that's why it's important to understand volatility in general. Because when you look at a 1 minute chart, 5 minute chart, sometimes the candles look pretty similar, right? They look similar in size. So that's why it's important to understand the measurement of them. How much risk should we be putting on the table? How much risk should we be taking off the table? Any questions on that? And that's the premise idea behind all of this. So to understand volatility deeply, I'm going to talk about how we look at it through a time series. What is a time series? A time series is just a sequence of data points and time order. So from this time to this time. Now, this is just the background information, and I just want to help everyone understand the background information because when you look at it in a chart, it's all automated for you, so all the hard work is done. But this is the background information of the indicator and what DTT is. When it comes to a time series, we're looking at it from a time order, beginning to ending, and then what happens in that. That's where our data is located. So some key concepts in time series analysis. We're looking at volatility clustering. What does that mean? It means high volatility tends to follow high volatility. Low volatility follows low volatility. This clustering behavior is why you often see markets in long periods of calmness or long periods of choppy behavior. And to put it in a simple way, I'm sure everyone understands this concept at this point: consolidation, manipulation, and expansion, right? This is the aspect I'm talking about right now, where you see volatility cluster up, consolidate, manipulates, and then expands and has a beautiful movement, and you can capture really large trades with that, right? So that's what I'm referencing with that. Now, why is that important? Because I've spoken about this in other lives, but when volatility has a manipulation, so let's draw this real quick again. It goes by consolidation, manipulation, expansion, right? This is just the background again, but it's so helpful to understand this because once you see it, you cannot unsee it, especially when there's data involved. This here, and I did not come up with these terms. These terms are used by institutions and financial markets. So I'm just letting you know right now. The term volatility clustering, I did not make that up. It's a real thing. It's just clustering of volatility in a segment of time. This manipulation, I did not all this is also a common use term. This is what you would call a mean reversion. It reverts back to the mean. So I've talked about this before, and we have an example up there that we'll talk about in a second. Then we have the leverage effect, a large expansion. So understanding this is pretty important because we can capture really nice moves. I've taken away the color on the chart. That way we can just focus on the aspect of volatility here. So why does this all matter? The background information, etc. Understanding these time series properties in the data and why it works, it allows us to predict and feel confident about potential periods of expansion, contraction, etc. So the reason I'm letting you know all the background information, and maybe later on in this year I'll make a book about it, is because it will help you to understand it more and why you should feel more confident about it. So that's the background information. And next, let's talk about how the indicator applies all this volatility in a practical application. Really simple. So that's the background. Here's some chart images. Next, let's talk about the indicator. So as we enter, again, this time period, this is drawn beforehand. I'd like to discuss, again, AMRP here. So what is AMRP? It stands for Average Model Range Probability. As we discussed earlier, this is the calculated and expected range of price from historical data, from previous models. So it's not gathering every single model and then portraying on the chart like this. It's gathering from Monday, 7 a.m. to Tuesday, 12:15 p.m. And it goes and references back in the chart those specific time periods, calculates the average move, and there you go. Now it's on the chart, automated. Why is this important? Because if I'm expecting bearish price action based on the higher time frame, I might wait to enter my position within this general area. The reason for this gives me much better risk to reward versus entering somewhere around here. Make sense? So for weekly models, which we're on right now, this is more so if you're a swing trader or if you're looking for pretty large movements intraday. This can be used for your, as we know from ICT terminologies, one shot, one kill. Sometimes all you need is one trade a week, and this could give you just that. If we proceed further, you'll see how price deviates away from the opening price and pushes to AMRP. Almost to the tick, right? Really beautiful. So it provides insights into the likely high and low of this time period. That's extremely helpful because if we're swing traders or perhaps we're looking for large moves intraday, we can capture a pretty large daily range and or swing trade as well. Make sense? So now that we understand AMRP here, we also have the capability of having a root candle and the previous model range high and low. So I've spoken about this before. When we have this root candle, we now have a couple more capabilities. It adds even more utilization with the indicator. So now I know this is likely how far price will go to the buy side because of volatility measurement. All I need is a pretty simple entry at that point. And what I like to do day in, day out is I look at the higher time frame. I then look to see what's the draw on liquidity, what's the easiest draw, and then I look for an entry. Your entry could literally be anything, right? You can use order blocks, you can use fair value gaps, or you don't have to use ICT. You can use something else. That's the beauty of this because you can capture large moves depending on your entry criteria, right? So These levels are calculated differently among different indicators, just like as its algo mentioned. It measures variability and volatility within this time period to this time period. And we also have a zone. So it's not just one predefined level, but we have a deviation away from that. So this general area is a hotspot for me to enter a short position. This is a hotspot for me to enter a long position. So this is all I do intraday, higher time frame, draw liquidity, and I look for my entry. Now that we have this root candle right here, I use it as a couple of three things here: draw liquidity, support and resistance, and last but not least, I use it to look at weakness and strength in the markets. What do I mean by that? If we were to look at the S&P within the same time period, I can look at that specific root to see if there's strength or weakness in the NASDAQ. So as you can see, it closed beneath it. And if we zoom in right there, failed to close above the opening price. And if we go to the S&P 500, we'll look to see the same thing occurred, which it did. And so that's all we do here when it comes to the indicator with DTT. This data-driven approach, it pretty much helps you anticipate market behavior. So by knowing the average range with volatility, you can pretty much just set realistic targets. You wake up, slap the indicator on, see how far it should go. You can also refine your risk management because it allows you to set stops and profit targets that align with historical data and volatility. And overall, it just improves your decision making. So instead of guessing where price is likely to deviate away from, now you're working with data-backed probabilities, and it's displayed automatically on the chart. So how does this work? It's like a roadmap. It overlays the expected ranges for price movements onto the charts, shows you a clear visual representation of where price is likely to go. It also highlights the high and low volatility on this table, and it makes it easier to spot trading opportunities. So I'm going to go a bit more in depth now that we understand pretty much the basics of what I like to use and incorporate it and how I incorporate all of this. But this is pretty much the basic idea of it, right? This is how useful it can get, because if you think about it, and I'm going to zoom in here in a second, I have the weekly indicator on, correct? This is on the 15-minute chart. So you can get a really large move, really large. But how would you refine this entry? So this specific area here, I'm going to go to the lower time frame now because I want to show you something really interesting. If I know on the higher time frame price is bearish, and I know this is how far price should go, I'm then going to zoom in to the lower time frame. And guess what? There is lower time frame models. So let's get to it here. This is the exact same time period. So I'm not going to proceed to the 1-minute chart. In fact, let's proceed to the 5. So if I know this is how far price should go, as we observed over here, guess what? We now have lower time frame models as well. What does this mean? Whether you're swing trading, whether you're scalping, whether you're looking for a large move, one-shot type of kill type of entry, now you have an even sharper entry on the lower time frame. So let's zoom in to the 1-minute chart and see how we can define this and look for a proper entry with this. As we remember before, these root candles, which are displayed here in blue, will be used as what? Support and resistance, drawn liquidity, and discrepancies in price between two assets. In this case, the S&P and the NASDAQ. So let's check this out because I want to show you something really interesting. Do we notice how the S&P is a lot stronger? We're not looking at highs here. We're not looking at short-term highs. We're looking at the root candle. It's a lot stronger compared to the NASDAQ. This is what I like to call a hidden SMT. It's nothing fancy, nothing complicated. You're literally just looking based off data, the strength and weakness in the market. We're not looking at swing highs or lows. We're looking at this here. So if we proceed back to the NASDAQ, this is the exact same time period. You'll notice how the NASDAQ is failing to close above that same candle. What does this mean? It means the NASDAQ is a lot weaker. To me, this gives me a very good mechanical approach and logical approach. That's the best way I can put it. It just takes any emotion, feelings out the window. I literally do this day in, day out. It gives me a logical approach based off data and automation here. And I know, okay, the NASDAQ is pretty weak. And keep in mind the higher time frame. That was the level we're looking for shorts at. And so then at that point, all I have to do is look for an entry. Whether I'm using fair value gaps, whether I'm using order blocks, whether I'm using inversions or turtle soups, you name it. At that point, you just need an entry. Make sense? So give me a 1 if all this makes sense so far. Let me know. Give me a quick 1. If everyone's on board, understanding the capabilities of this and how mechanical and logical it could become. Perfect. Yeah, so at that point, you just find an entry. So in this case, I think I took a trade here on this specific day. You could probably find it on Twitter, but this is the exact reason, and I'm showing you that pretty much the trade breakdown of why I took a trade here, capturing pretty much almost the entire daily range. Why? The higher time frame told me to do so. If we go back to the weekly models, it told me to do the same thing. At that point, I just go to the 1 minute chart, I look for an entry, and I write it out. Once I find my entry and price begins to distribute down, I will then proceed back to the higher time frame and trail my stop accordingly. So as we can see, we're now back to the weekly models. We captured a pretty good trade if we entered around here. This happens day in, day out. With multiple instruments, you can see the same ideas and techniques on crude oil, gold, Forex pairs as well. And once we break down below the root, it's the same idea. Remember what I mentioned earlier? This would be your support and resistance, drawn liquidity, and also discrepancies between the S&P and the NASDAQ. So once this breaks down, we get a closure beneath the root candle. There's a couple wicks here. Price closes beneath, large wick. I can enter a sell position, stop above the root candle. This is just for a showcase of what I would look for. And I can target sell side or perhaps just this lower end. You can do this day in, day out, managing your own leverage, etc. But this is just an example, right? That's the breakdown. So we can also look at this on crude oil. And I'm pretty much showing you the basics, how it works, the background information, and then how I do my daily analysis and how I'm able to capture using my system, in this case DTT, pretty good trades sometimes. Not every trade's going to pan out. That's just the truth of trading. But overall, this system is pretty refined. So if we look at crude oil, let's do a quick analysis. On the daily chart, we'll mark some important levels here, just looking at some higher time frame liquidity. But what I want to get to is the same idea that we just saw on the NASDAQ. Notice a couple things. Looks like crude oil has been on an uptrend recently. And if we notice here, what did the price do? Deviated away from the average range proceeded further, closed below the root candle. You can use this for a quick short down to the sell side. But now that we're here, we're combining the higher time frame because it's bullish. I will then look for price to give me an entry here. And as I mentioned earlier, you can look for a sharper entry on the lower time frame models. Same thing up here. If price is pushing to the buy side and the higher end of AMRP, I can then go to the lower time frame models and use the same exact framework, the same exact techniques, the same exact mechanical approach, and just look for an entry there. So let's actually look at to see what price did around these levels on the lower time frame. Give me a 1 if you are still following along. It's a pretty simple framework. Perfect. So as we can see here, this is probably one of the best examples for crude oil this week. When you mesh everything together, and it becomes pretty obvious, the higher time frame is bullish. We're looking for a continuation to the buy side. Let's say I want to begin a swing position, or I want to capture a one-shot, long-kill type of trade. This is my general area for price to approach the sell side, in this case AMRP. And if we go to the lower time frame, we can see we have AMRP on this model now. This is a London model, what I refer to as turncoat. I give each model a name just to distinguish them because sometimes they have different characteristics, but they all have the same framework and mechanical approach. So this is crude oil, and as we know, this whole area down here is a good buying opportunity for a swing position. So at that point, once again, all I need to do is find an entry using the same framework. As you can see, price is holding AMRP on the lower time frame model. If you didn't capture that trade, you can then use the root candle for support and resistance, as I mentioned earlier. Better case, you would wait to see if price can push down to this area. But if it wants to use it as support, as we can see there, we can capture a trade there. The 1 minute definitely looks a bit clunky. So in this case, and in this scenario, I'd probably go to the 5-minute time frame and look to find an entry there, right? It's pretty much that simple. What this does is it gives you, again, redefined risk management. It helps you anticipate market behavior, so it amplifies your patience. And overall, it improves your decision making based off data and historical volatility. So now, because I want to talk about volatility, I also want to mention when should you embrace volatility. So high volatility periods are ideal for traders who thrive on movement. So if there's ever a large movement in the markets, such as Tuesday of this week, this large drop, we'll break this down in a minute. This is where you want to embrace the movement and you want to let the trade run. There's a big difference, and I'll talk about this here, between knowing the conditions. Sometimes if you try to let a trade run, the market is not as volatile, correct? And in this case, more recently, we saw this type of day here, Wednesday. On this day, when you're expecting a large volatility swing, I will likely look for price to continue going to those data-backed levels. And in this case, if I enter a short position up here, using the same framework I just mentioned earlier, then I will let this trade run all the way down. So how do we notice the difference? How can we find out the difference? How can we figure out there's more volatility than average? Well, let's proceed to the lower time frame here. And in this case, as I mentioned before, what is this blue box here? the root candle, correct? What did I mention before? It will be used as support and resistance, drawing liquidity, and or weakness or strength in the market by looking at the S&P and the NASDAQ. So let's look at 950. Notice how 950, the S&P did not tap into the root candle. And then we'll proceed back to the NASDAQ. And at 950, what did the NASDAQ do? It tapped the root candle. So to me, as you can see, I'm not looking at liquidity levels like this for SMT here. I'm looking at a data-driven strategy. And I'm looking for price to push into this specific candle and opening price. So if I were to zoom in, you can see how it's using that specific opening price right there. And at that point, I will look for price to deviate away from that. So now the question is, how do I know there's more volatility than average? What should I be looking for? Well, let's go to the lower time frame in the intraday models to understand how volatility can be incorporated into your analysis. Why is this important again? Because if we understand there's more volatility than average, I will probably want to decrease my risk size, and at the same time, I might want to let the trade run. Two things, right? Decrease risk. Number two, let the trade run. So let's quickly analyze this, and we'll see how we can understand when there's more volatility in the market. This gets automatically calculated. So I've spoken about this before, but this is the average range of each model. So as we can see here, from this time to this time, it should be 102. Correct? From this time to this time, it should be 114 right there. So let's zoom in and understand why is there more volatility and how can you see it? Well, if I'm trading without this, this looks like a normal 1 minute candle, correct? Give me a 1 if you agree. This looks like a normal 1 minute candle to the normal eye. Just type a 1 if you agree with that, right? We can all agree that this looks like a normal candle. However, when you actually measure this out, let's see how many points that is. Do we all see that now? It's a really large move, correct? So because of that, like I mentioned earlier, we're going to want to lower risk. But if we capture a pretty good entry, we're going to want to let that thing run. Because we know, oh, today I woke up, it's supposed to be at 114. This is the average model range, AMR. But if we look at it here, wow, we're at 219 on the day of movement. So to me, on this day specifically, wow, there's a lot of volatility. I might want to let my position run, perhaps to a higher time frame drawn liquidity, or if we proceed back to the weekly models, I might want to let my position run further down to this root candle or AMRP down here. Makes sense, right? That's the difference. If we can simply automatically calculate how much price is moving, it helps you do two things. It helps you manage risk, and at the same time, it helps you understand when to let positions run and when to take profits early. Because there's a big difference between this day, as we can see here. Look how it's overextending, proceeding further away. Whenever this happens, because again, this is based off historical data, this is a logical way to do it. And it's pretty mechanical. Again, this is AMRP, historical volatility. So it's pretty logical for me to slap a standard deviation. Why? Because I'm just extending the data. So if it's going away, I'm just adding a standard deviation onto this. Makes sense, right? And so I can capture perhaps a further trade if I capture an entry up here. Now there's a key difference between this day and Wednesday's price action. So if we look at the same thing, let's take a close look at Wednesday's price action here. I'm going to quickly populate pretty much every single model of the day because it's going to be pretty interesting to see. The morning conditions. Notice how price snapped away and went straight back down to MRP. We'll go to this in a second. Price stayed within this range here. Price extended outside of the AMRP. What did it do? Came all the way back down at a specific time, straight down to the sell side. Overextended again. And if we look at the volatility here, we can see compared to Tuesday, the volatility is not too high, right? If we remember correctly, on Tuesday, what was the range? Above 200, right? On this day here, 128, 167, 100, 208. So out of the entire day, this day here had the most volatility. This model right here. So something I like to talk about frequently is overextensions. This is why it's so useful and powerful. If I have a higher time frame PD array, I'm pretty sure there was a fair value gap here. This is just for the sake of an example. You can see how easy it is to capture some pretty decent and quick scalps, right? So that's my fair value gap. And at the same time, if we proceed back, actually, you'll see how that's the root candle as well. Right here. What did I mention earlier? Support and resistance based off that, right? So if we go back to the 1 minute chart, let me turn off the root candles for now. And I just want you guys to focus on AMRP here. As price deviates away from the expected range, it quickly snaps back into the range. The opposite AMRP here, or the opening price. What's the opening price? The beginning of the model. So 955, the next one 1020, and so forth. Make sense? So as we can see here, this is one of my favorite type of trades to take. When we have an overextension, and I know the higher time frame is bearish, I will likely take shorts in this area here because we're in deep premium of where data is telling us price should not be. So if I find an entry criteria, I can quickly enter here, take profits at the opening price, or hold until AMRP, or perhaps a higher time frame target. Same thing here. Price wicks above, comes back to the opening price, wicks above, comes back to the opening price. Same thing here. Closes above, and at a specific time, comes all the way back down to the opening price, AMRP, and this AMRP down here. Make sense? Any questions on that? So there's all kinds of things I just referenced here. And it's pretty simple framework, as you can see. It's just day in, day out, just putting it in on the chart and understanding it. So I hope this was a pretty insightful and clear portrayal of that, the background information, how to apply it properly, what to look for, and how simple and easy it could be when you have this on the chart. So now I'd like to proceed to a quick Q&A. If anyone has questions, I will likely answer them right now. Currently, it does not work on stocks, but soon to be, yes. Eventually, we will have it. I don't want to spoil things, but there's something in the works for the higher time frame and stocks. Of course, so these are the indicator settings I like to have on. I apply this during different framework, previous bar range. In most cases, I have it off, and I apply it during consolidation or raging environments. But these are the settings. So if you want to avoid the warning and change this, I simply go to this here, turn all this off, make this a 4, make this a 5, and there you go. Now it should only display on the 5-minute chart all the way to the 4-hour chart. If you do not want it on the 4-hour chart, simply make it so it's maxed to the 1-hour chart. It is different in regards to that it measures historical volatility, and it's not measuring the opening and closing prices, but more so the opening price and the standard deviation away from that. So as we can see here, it calculates the volatility of historical data in the previous models. In this case, it would be AMRP. It then draws a deviation on that for both sides. As we can see there, -1, 1. This becomes your zone for shorts. Vice versa, if we're looking for longs down there, this becomes your zone for longs. And when it comes to this indicator and DTT, it's a whole framework in of by itself. As I mentioned earlier, I pretty much just handed 3 or 4 frameworks surrounding the root candles there in this video. So it's a whole framework in of itself, and that's the beauty of it. You don't really need a different approach to the market. Can you? And personally, I do. Yes, I still use ICT. However, that's just to refine my entries a bit more. The root candles are determined from historical volatility. So these are, let me see if I can find an old chart, an old example. But when you're looking at specific candles of the day, you'll see spikes of volatility, orders being inputted, volume increases at specific times. So that's where the root candles originated from. For the look back setting, I like to have it on 9 for all of them. So I keep it on 9 there. Right, you can trade from root candle to root candle. You can do this with swing trading as well as intraday trading. So, for example, this is your root candle. The previous root candle's down here. We'll see how price pushes back down into that. You can also trade from root to root. Nope, the times are static for the root candles, as well as the models that are static now. It's a static approach, but measuring volatility based off that with data. We got all kinds of updates coming for sure. So we're looking at sub 1 minute, and as well as on the higher time frame, daily, weekly. So I'm really excited for all of that. Rubber band strategy, yeah, that's what we call a mean reversion. So it's not a term I coined up. It's commonly used in the financial markets. But to put it simply, talked about this here. We'll just draw a quick diagram. You'll have your opening price. This works similarly for hourly, 4-hour candles, any type of OHLC candle, right? What a mean reversion is, you have your opening price. If price begins to deviate away, it can come back and hit the opening price. It's pretty similar to the power of 3, etc. It's just how a candle works, but in this case, now we're looking at from historical data and time and volatility. But candles work the same. So it deviates away from that, comes back to the opening price. And a lot of traders try to capture that type of trade, right? But what makes this different from that? Well, you have data available. So now we have a zone. You have a zone here. You also have your root candle. So I can use that as support and resistance, my own framework. I know my own entry as well, using the S&P or the NASDAQ for hitting clues, right? And that's all it is. So now you have pretty much a strong way to trade from this time period to this time period based off data. Yep, everyone's going to get the indicator updates. We're just going to add more things to it. It's going to be really nice. It's this specific time, again, because when analyzing historical data, these are the times where there's increased volatility and volume as well. I'm hoping to release a free book, obviously, later this year, talking about the background information about DTT, and that might be really interesting. Great question by AB Moed. Is there any point where AMRP fails? Yeah. So when there's increased volatility, it's going to deviate away from that. So that's actually a good question. And as I mentioned earlier, what do you do in that circumstance? If anyone can answer that, I mentioned it briefly, but for example here, right? What do you do when it starts to proceed lower? When it starts to proceed lower or higher past AMRP, slap a standard deviation. There you go. It's that simple. Why? Why does this work so well? Because again, it's based off data. So I'm just extending the data out. You can see how it taps -1, -2, -2.5. That's pretty interesting, right? My indicator settings in the Discord, sure thing. I think there's a template available. I can link that later. The difference between the opening price and equilibrium on the indicator settings. The opening price, if we go back over here, we can use this for entries in of itself, right? Let's say I don't want to look at the entire root candle. And let's say I capture a short entry here. Maybe I'm doing a swing position with the proper leverage. I can put my stop above the root candle high, correct? But what I want to see is simply just the opening price hold. So if I were to just have that dashed line on there, you can see how that becomes a resistance area for price. Wicks above, comes back down. Wicks above, comes back down. Now, why is it important to look at equilibrium? When you're in a trend environment, I will look at equilibrium. The reasoning for that is because price will often use equilibrium to continue higher. So if I were to go to this area here, actually this time period here, there's a really good example of this right here. So why is it important to look at equilibrium of a root? We'll look at equilibrium here. I'm going to turn off AMRP just for a second. And then we'll just focus on the root candle. During a trend continuation, whether it's a short-term trend, longer-term trend, you'll see price hold and use those equilibrium levels. So this is actually a really good point because I pretty much just summarized the entire background and framework, but at the same time, what's important with DTT and why it's so useful, at least to me, take it as you will, is because it gives me a mechanical, logical approach, but at the same time, it helps me to adjust to what the market is telling me to do. If the market is volatile, like I mentioned earlier, I will decrease position sizing and I will ride my position longer. If the market is not too volatile, I might avoid it altogether, or I might be okay with increasing leverage because I know the market's not going to move too much. And at the same time, if the market is trending, I will then use the root candles for a trend continuation. You can see how it's holding equilibrium, equilibrium, comes back, taps equilibrium, goes higher. So that's the beauty of DTT. It helps you navigate the markets with logical approach and adjust accordingly. Is it ranging? Is it expanding? Is it reverting back? Is it manipulating, etc.? So, any other questions here? I'd say if you're just starting out, I would definitely recommend focusing on AMRP. Once you understand that and can see how that's pretty powerful and you can incorporate that, add the root candle and you'll see how much easier it gets. Well, this has been very fun. I hope this has been informative as to the background information. And volatility in general is not something to fear. It's something to understand and embrace, and that's what DTT is. By combining these insights, you can have disciplined risk management, and you can actually turn volatility into your greatest friend and your greatest ally. So I personally love volatility, and that's what DTT is all about. So I appreciate everyone's time today. I hope this was insightful and it gave me more insight into how I approach the markets. So I look forward to seeing how you all incorporate it. If you have questions, I will be available here in the Discord. And you can check my daily activities or weekly activities on my Twitter profile as well. You can get some insights from some of the trades I take as well, putting it to the test, putting it in a real live environment with actual funds. So I hope that's insightful as well. Have a great day, everyone. God bless.